Non-cash and investing and financing activities are included in the statement that follows the presentation of the cash flows. So, what are we talking about in non-cash investing and financing? Primarily, we're talking about trades or swaps. We may trade stock for assets. We may trade one type of equipment for another type of equipment. One piece of land for another piece of land. So these are all items that need to be disclosed, but they do not involve cash, and because they do not involve cash, they can't appear on the statement of cash flows. Now let's talk about some cash flow ratios. First, cash flow per share, and then we'll talk about free cash flow. Cash flow per share is calculated by taking the net cash from operations less any preferred dividends that are paid out, divided by the average number of common shares. Now let's assume that we had net cash provided by operations of $3 million. We had preferred dividends of $100,000, and we had the average shares outstanding of 2 million. So we divide 2,900,000 by the average shares outstanding, and we get $1.45 per share. Management, financial analysts, and investors are very interested in this particular number. How much cash per share has been thrown off by operations to be used in the expansion of the business. This would be particularly severe if we had a negative cash flow per share. Now, FASB prohibits firms from reporting this in their annual report, but a financial analyst or a prospective investor can calculate it very easily from the information that's provided from the statement of cash flows and the shares outstanding of the capital section of the balance sheet. Now, free cash, we're talking about cash provided by operations less investments in property, plant, and equipment. So let us assume that cash thrown off by operations was $2 million and we had capital investments of $500,000. This means that the free cash flow is actually negative because we're investing more cash than is being provided by operations. So it would indicate that we've had to go outside and either borrow this money or we're going to have to sell stock to raise this money, because that's the only other source that we can use to get the money to increase the property, plant, and equipment. Now, this is not necessarily bad at one point in time. It may mean the company is currently engaged in some very substantial improvements. And next year, we may have a positive free cash flow. Now, also, a high positive free cash flow may mean the firm is not investing enough in new equipment, repair, R&D, things of that nature, which they need to do to maintain the viability of the company. If they have too much high free cash flow, the investors may step in and start demanding that a dividend be paid out rather than just let the firm hang on to the cash without using it. Recently, there was a lot of pressure on Apple, who were carrying huge cash balances, from the shareholders to either invest that money or to pay it out in a dividend. The company was already investing a great deal of money in R&D, so basically the investors demanded a dividend to give that cash back to them rather than just having Apple harbor it in their bank accounts. Working capital. This is another really key element as to how liquid the company is. Working capital is calculated by deducting current liabilities from current assets. For a firm to be viable in the long run, this number needs to be positive. We need to have a positive amount of working capital on hand so we can meet our creditors when the bills come due. Management can maximize the working capital by focusing on and managing its current assets and current liabilities. And they will do that by looking at the various ratios we've already discussed, and some I'm going to present here in a couple of minutes. but it's important that the company have positive working capital. Again, management will probably look at the financial statements of competitors in the same industry to see how they stack up with their working capital in comparison to their competitors. Let's talk about working capital cycles. We have two of them, the operating cycle and the cash conversion cycle. The operating cycle measures the time between the time that we receive the raw materials into inventory and collecting the cash from the receivable. So we're focusing on inventories and receivables. Now the cash conversion cycle is arrived at by looking at the accounts payable cycle and deducting it from the operating cycle to get the cash conversion cycle. So in other words, how many days are outstanding to collect our money, and then we subtract from that the number of days we take to pay our vendors. So that becomes the cash conversion cycle. Again, here's an example. Days outstanding in inventory plus days outstanding receivable represent the operating cycle. The conversion cycle is the operating cycle less the average payment period of accounts payable. Here's a calculation of the average payment period. You take the accounts payable and divide them by the average cost of goods sold, and then factor it by the 360 days. So, assume you have accounts payable to be $50,000, the beginning COGS is $600,000, the ending COGS is $500,000, so the average cost of goods sold is $550,000. Divide that out by 50,000 and you get 9.1 times. So then take 360 and divide that by 9.1 times and you arrive at 31.9 days. So that is the average payment period. On the average, you pay your bills every 39.5 days. Now let's talk about getting and keeping the cash. Management focuses on reducing the days outstanding to generate cash faster. They may also extend the days to make payment to vendors to hold the cash longer in their own accounts. Now, one thing you should be careful of is that you should not go outside your payment terms with your vendor because you don't want to hurt your credit. And basically, you shouldn't be paying your accounts payable any faster than those of your competitors. So again, by looking at comparable financial statements, you can determine about how your competitors are paying their vendors, and you should be pretty close into the same range. Another area we're focusing on is float. Float refers to the time it takes from the customer writes the check until it clears your bank. So delivery float is the time it takes to get from the customer's payment point to the point where it's received by you. Now, that could be the mail at your office, it could be the lockbox that we talked about earlier, either of those. The processing float is the time it takes to process the check once it's received at the delivery point. And this might be a day or 2 days or 3 days, depending on how fast you process your checks. And then the clearing float refers to the time it takes the check from the time you deposit it in your bank account to clear the customer's account. Float has gotten very much reduced from what it used to be because with the use of lockboxes, electronic transfers and things of that nature, the float has gotten down to a very short window, sometimes just a matter of 3 or 4 days. We talked about accounts payable, and you need to look at this in 2 ways. Right now I'm going to talk about creditworthiness in terms of you granting credit to a customer, but when a vendor grants credit to you, they're going to be looking at the same type of criteria. Character, capacity. Do we have a character? What kind of reputation do we have? Do we have a good reputation in business of paying our bills on time, being fair, not being argumentative, not be whittling away, that type of thing? Do we have the capacity? Do our customers the capacity to pay that bill? What do they have for capital? Do they have any collateral out there that we may want to take a hold of? And what are the business conditions? Are we in a recession? Are we in a time where people are slow paying their bills and so forth? Of those 5 items, the most important by far is character. You can have the other 4, but if a company does not have good character, then probably it's somebody you don't want to do business with. And here I think we're harping back a little bit to the ethics discussion we had in module number 7, where we talked about how people conduct their business. How ethical are they?